Presented by PolicyBazaar.
CNBC TV 18, the PolicyBazaar Insurance Show.
India has the world's largest youth population right now, which sounds like a big win. But here's the twist. We're also aging faster than ever. Our elderly population is growing at a massive 41%, and by 2050, around 319 million Indians will be over the age of 60 years. That's about 1 in 5 of us. Now, here's the real concern. Only 12% of our working population has any formal pension coverage. And when it comes to retirement savings, India's pension assets are just 17% of our GDP. To put that in perspective, many developed countries are around 80%. Even more worrying, only 27% of Indian households are actively saving for retirement. No surprise then that India ranks second last amongst 44 countries in Global Retirement Index. That's exactly why in this episode of the PolicyBazaar Insurance Show, we are focusing on one of the most important yet often overlooked aspects of financial planning, the retirement puzzle. We'll also break down how unit-linked insurance plans, popularly known as ULIPs, can play a powerful role in helping build a secure retirement corpus. Now, to explore this in more detail, I'm joined by Madhu Burugupalli, Head Product Development and Strategy at Bajaj Allianz Life Insurance, Srinivas Balasubramanian, Chief Marketing and Digital Business at ICICI Prudential Life Insurance, Vivek Jain, CBO Life Insurance Business at PolicyBazaar. Let's start this discussion, gentlemen, and to come to you, Mr. Srinivas. India's retirement gap is widening, correct, despite rising incomes. Now, so what are the risks which are delaying retirement planning according to you, particularly in a country like India, where pension coverage is so minimal?
Yes, hi Yash. I think that's a great question to kickstart this whole session. Before getting to the risk part, I'll just take a minute to talk about the possibilities. You know, if you really look at your life and you define quality of life as being premised on how much money you have, how healthy you have, and how much time you have. So a person who's in his or her 30s or early 40s today is perhaps in the prime of their life and therefore in good health, earning good income. So the money part is taken care of. Time is what they miss out, right? And that becomes a serious drag on the quality of your life. Come to think of it, retirement can be that part of life where if medical care is there and it's getting better, so health is going to be taken care of. Time is going to be your biggest asset and you're going to have a lot of time on your hands. And the money part, if you have done proper retirement planning and therefore the money part of is taken care of, then truly the life after 55 or 60 can be the best phase of life. So to coming to your question, the biggest risk is at an individual unit level. If you get this planning part of it wrong, then that phase of life, which can perhaps be the most enriching, most meaningful, most satisfying part of your life, could be something less than that. So that is a risk at an individual level. Coming to the financial part of it, I think the risks one needs to take into account is the longevity risk. Second is there is a risk of health emergencies. So a holistic retirement plan should also sort of address that particular risk. And third is if you delay the act of retirement planning, the start of your retirement planning, and this thought occurs to you, let's say when you're about just 5 or 7 years away from your retirement, then it forces you to start taking some risks, right? And that may or may not play out. So these are some of the risks of delaying retirement planning, and that one needs to factor in when it comes to kickstarting the whole exercise.
Madhu, to come to you with the next one, we spoke about ULIPs in the introduction, but these products have evolved over the years with lower charges and greater transparency. How well suited are they today and specifically with respect to long-term goals like retirement?
See, I think one of the most important things that we should note is people tend to often underestimate how much they need for retirement. And consequently to that is how much they actually need to save from today. Now, what you need is a proper plan. Unit-linked products over time have actually come down in terms of charges, have come down sharply over the years. One of the biggest, IRDA has played a critical role in this in terms of capping the charges that can be charged in a ULIP. And that's actually played out in terms of offering better value to customers. And since retirement is also a long-term goal, and that's why our unit-linked products, especially a unit-linked pension plan, can be a very good option for someone to save for their retirement.
Vivek, to come to you, how does a product like ULPP compare to a traditional retirement instrument like an NPS or PPF in terms of flexibility, returns, and tax benefits?
I think both PPF and NPS are also great products. PPF have give you more guaranteed kind of a return, which changes every quarter, typically in the range of 7% and maybe it may change to maybe 6 to 8% is the range of return that you can get. The benefit there is that the return that you make is completely tax free. But if you are looking at a longer term horizon of 20 to 30 years, then maybe equity exposure can give you better returns than that. But still, I think given it is 100% tax free, it's a very good option. Comparing NPS and ULIPs, pension ULIPs, see, NPS again is a very, very good option for retirement. The positives in a pension ULIP that you get is that in NPS, you can only have up to 75% exposure to equity. Versus in a pension ULIP, you can go up to 100%. And especially if you're younger, you would want to take more risk and be part of the India growth story. So if you have 100% equity exposure for the first maybe 5 years, 10 years, you'll end up making a better corpus. The other thing is that switching and all is very, very easy now in the digital ULIPs that are available. And one more thing, and I think this is something that is a very, very recent trend in the Gen Zs and millennials. People want to retire earlier. People don't want to retire at 55 or 60. So NPS there, you only actually get the corpus at the age of 60. In a pension ULIP, you have a flexibility. Supposing you are a 30-year-old, you can choose a 15-year or a 20-year policy term. And if you want to retire at 45 or 50, and basically you get 60% of your corpus tax-free, and you can buy annuity for the next remaining 40%, and you get a regular pension. Basically, ULIP pension will give you more flexibility to choose the age at which you want to retire rather than fixing it at 60. Also, it gives you higher exposure to the India growth story and the equity market. So long-term wealth creation can be better with pension ULIPs.
Madhu, to come to you, retirement planning, I mean, is all about balancing growth, at the same time looking at safety, with all caution. How can ULIPs help investors manage these two dual objectives? That is, of course, growth. You certainly need growth, but at the same time, you need safety also, which, if not less, is equally important. How does a product like ULIP help you sort of manage and juggle both these objectives that you don't miss out on?
Retirement is, it's as critical a goal as you can think of, because when you save for retirement, you're actually saving for the 20-25 years that you are saving for, and after that, you're actually hoping that the money should last you or should be enough for you for the next 20-30 years thereafter. So it's very important that you have a plan and you stick to that plan in terms of what's an appropriate asset allocation for you, and stick to that. A lot of our insurance products in the market today offer you various portfolio strategies, which is, for example, you can link it to your life cycle. Now, what happens when you link it to your life cycle is that, when you're younger, you can have a higher exposure to equity. As you grow older, when possibly your risk appetite reduces, you can actually gradually shift towards debt to start taking lesser and lesser risk on your retirement savings. And one important thing that most companies offer is about capital preservation as you approach maturity, as you approach your retirement age. You've saved for 20 years. And suddenly the moment, maybe a couple of years before retirement, there's some huge volatility in the market. You don't want your retirement corpus to be at the mercy of that. So we have products offer capital preservation as well, where you gradually shift whatever you have money in, whatever asset class, you move it into a debt or a liquid, maybe a year, 2 years before you actually retire. But I believe that with various portfolio strategies that are there, like life cycle, switches, I think insurance companies, that unit-linked pension policies that are there, can actually help you make the best of various market cycles to get both growth as well as to protect your savings.
We've had a good discussion so far in the first half. On that note, let's take a very short break. We discuss a lot more about retirement planning and how that can be done through pensions products of insurance companies. How effective of an instrument can it prove to be for you? We discuss more on that on the other side of this very short break.
CNBC TV 80, the Policy Bazaar Insurance Show. CNBC TV 80, the Policy Bazaar Insurance Show.
Welcome back to the Policy Bazaar Insurance Show. Today on this episode, we are discussing a very critical piece when it comes to individuals' retirement planning in a country like India, where the median age has been growing very, very rapidly. We discussed that part of it, and hence what makes it very important to have a sound plan when it comes to your retirement. Taking that objective to you, Mr. Srinivas, and asking you a question, can ULIPs serve as an annuity generating vehicle post-retirement, or should they primarily be seen as a wealth accumulation tool? How do you see these two aspects?
Sure, great question, Yash. So I think, both Madhu and Vivek spoke about it briefly earlier. There is an inherent versatility to a ULIP, right? So honestly, depending on the point at which a person is investing into the ULIP, it can serve both of these purposes. And the beauty of it is you can start a ULIP with an objective of using it primarily as an accumulation tool. With, let's take the example of a 35-year-old who starts investing regularly in a ULIP and has a premium payment horizon of, let's say, 10 years and wants a corpus to be accumulated at the age of 55. So that's 20 years from the time of the policy inception. The beauty of a ULIP is you can enter the plan with that as an objective. But as you come closer to the goal, if you say, fine, you know what, I have my corpus getting accumulated to some other avenue, can this be converted into a regular income generating option? And that's where the systematic withdrawal plan, which is a feature Madhu briefly spoke about, comes in. So you can, at the 20th year, you can say, look, whatever corpus has been created, let me take it systematically, monthly, quarterly, or annually. And it pretty much then becomes a annuity generating tool. So you can enter the plan with the view of it becoming an accumulation tool. And midway through the plan, as you come closer to the end of the plan, you can say, I want it to take the form of an income generating structure. That can also be done. Of course, if you want to stick to your original plan and just want to create a kitty, which you then want to repurpose the way you deem fit, that option is also there to the policyholder. So there's a versatility and a flexibility. So both the accumulation part as well as the income generation part, both of these objectives can be quite well addressed to the design of a ULIP.
Vivek, to come to you, what kind of asset allocation strategies within, let's say, a ULIP product would you recommend for someone in their 30s versus someone in their 50s?
So I think if you are in your 30s, I think you have started early, which is a very, very good thing. So maybe you should start with 100% allocation in equity, because the person still has 15-20 years at least at the bare minimum for the corpus building. So I think you can start with 100% allocation in equity. Depending on your risk appetite, you can choose large cap, mid cap, or even flexi cap funds to build your retirement corpus. But when you come closer to your retirement age, or if you're starting late at 50, then you should look at more of a balanced fund kind of a strategy, where you have some equity exposure to give you a upside, maybe 50%, 40%, depending on your risk appetite. But at least 50% should go into debt and money market instruments, so that you have some safety net when you are closer to your retirement. So as a 30-year-old, you can have 100% equity exposure. But when you are near retirement or at 50, if you're late to start at 50, you should always have a balanced approach. And I think nearer to the retirement, you can move to 100% debt, so that in case there is some market volatility, you are not impacted by that.
Madhu, to come to you, many people still perceive ULIPs as a high cost or rather an opaque instrument, which does not give a lot of transparency. What are some of the common misconceptions, and how do you think ULIPs today address these misconceptions which people still have?
Thank you, Yash, for bringing that up. And I hope I can use this platform to actually break some myths that are there regarding a unit-linked product. Now, uh, they've copped their fair share of blame that people put on ULIPs. But let me just articulate some of these misconceptions and let me see if I can help change some minds here. First is that ULIPs are high charges. IRDA has actually brought out several regulations which cap the amount of charges that one can charge in a ULIP. So what IRDA has done is also they've introduced a terminology called reduction in yield. What it means is IRDA says, for example, if your fund earns, let's say, 8%, what is the maximum reduction in that yield, and hence what is the net yield that you should give the customer. Now, this is actually inclusive of all charges, other than some mortality and some government taxes. It includes all charges that are there in a product. These are transparently shown in a benefit illustration. And if you look at this number for most companies, and I would say for all companies, is substantially lower than what even the regulators asked for. So the first myth is it's of high charges. That was probably maybe 2 decades ago, or maybe 15 years ago, when ULIPs was probably still in their infancy. Over the years, the regulator has made this, and lots of insurance companies, so we have actually reduced the charges as we went along. Second is on myth is on transparency. I mean, you also stated that ULIPs and transparency. Yes, ULIPs do have different heads of charges, but every single charge is disclosed in something what we call, and it's mandated by the regulator, called a benefit illustration. What this does is this actually lays out step by step, year on year, at IRDA's prescribed return. I can't show return whatever I want to. The minimum statutory required that IRDA has prescribed me two returns, 4% return and 8% return. On that return, how much do I charge from the customer? What is the fund value at the end of each year? That is actually very transparently disclosed. Unit-linked products offer various funds, their NAVs, their benchmarks, everything, the fund performance, everything is very transparently disclosed. And one final myth that's usually there is saying that your money gets locked in. Now there are two things that I would want to say in that. A unit-linked product, first of all, whether it's a pension or not a pension, has a lock-in of 5 years. And after 5 years, you can actually exit the policy. If you have an emergency, you can always exit that policy. And even within that, or even any time during the policy term, what they offer you is unmatched in terms of offering you flexibility to switch between funds uh, tax-free. So what happens usually is people might say that, I'm stuck in a fund, the markets are falling, can I get out of the fund? Answer is yes, you can. So these are, I hope at least these are some of the myths that are there, and what I believe are solutions, or at least what from my side I would want to bust those myths with these three examples.
Srinivas, now to come to you, just to understand, as you're speaking about these products, what are the biggest mistakes that people make, when using ULIPs for retirement, and how can they avoid them? Because this is very important. These mistakes, though made by people individually, do create trust deficit in many situations, and that communication gets passed on. So tell us, I mean, to your knowledge, as you come across, what are the most common mistakes and how can they be avoided?
The moment a customer or a policyholder buys a ULIP with the perspective of retirement planning, I think a large part of those traps are in a way taken care of, with the assumption that the person buying this is someone who is in his or her late 30s or early 40s. Because what this means is automatically the ULIP is being bought with a long tenure. And that is the biggest thing that one can do to get the best possible benefits of a ULIP. Think of it as something meant for your long-term goals. So yes, to answer your question, inherent in it is a natural safeguard, because if you're buying a ULIP as a retirement plan, and if you are, let's say, in your late 30s or early 40s, you're doing absolutely the right thing. Some of the things which I have observed from how customers typically engage or use the ULIP and what they could do better is there are multiple flexibilities. In a ULIP, regardless of whether you are an equity-oriented fund or a debt-oriented fund, if your premium is up to 2.5 lakh, there is no tax. It's tax-free. The benefits are tax-free. Even for premiums beyond 2.5 lakhs, It is very simple and straightforward. Regardless of whether you're in equity or in debt, it is at 12.5% flat LTCG, right? On the majority, on the gains that you're going to get. So there is a tax efficiency which is there in a ULIP, and on top of it, there are these so many fund options. So customers not utilizing the flexibilities of a ULIP is perhaps the biggest, I would say, loss for them. Because again, coming back to the point, the moment you're buying a ULIP with a long-term goal, you're sorted. If you want to make the benefits even more, then please make use of some of these flexibilities. I can think of the SWP, especially from a retirement planning point of view, switch from a generally making the most of market cycles and still having a tax efficient solution, and topping up as and when you have surplus funds. If you want to channelize it towards your retirement corpus building, the ULIP offers a very clean, efficient way of doing that. So utilizing the flexibilities, or rather underutilizing the flexibilities, is one misstep which I think customers should try and avoid the moment they go down the ULIP path.
One concluding question as we wrap up this discussion, and this goes to all the panelists, Vivek, Madhu and Srinivas, starting with Vivek. And I would really appreciate if you could keep your answers brief in this one. Given India's low ranking when it comes to the Global Retirement Index, what regulatory change, what is that one regulatory change or ecosystem level shift that you believe is necessary to make ULIPs a more powerful, more accessible tool for retirement planning? One suggestion from each one of you, a quick one, starting with Vivek.
Yeah, so I think one thing that the government can help in basically retirement planning is at the time of maturity in a pension ULIP, 40% of your corpus, and you can go up to 100%, can go. You buy a annuity product. So the regular pension that comes out from a annuity product, if that can be made tax free, that can really give a very, very big boost for the end consumer, because at that time you're not earning and you're dependent on the pension income, right? If that pension income can be made tax free, that can really give a big boost for retirement planning.
Mr. Srinivas?
Yes, yes. So you know what, as an insurer, in non-linked policies, what are known as the traditional policies, as an insurer, I can provide loans to my customers, right? So it just makes the product seem a little more liquid. In ULIPs, currently that facility is not there. So even if a policyholder does come to me with the need for, look, is there something that you can do? I sort of put the customer in touch with lenders. So the moment the regulations allow even loans, the insurer to provide loans against ULIP, it just makes the product seem a little more liquid and just makes it a little more easier for customers to engage with.
Madhu, final word to you on this one.
People use ULIPs or whatever be the mechanism to actually save for their retirement. If you could reduce some GST on some of these charges that we do, there is a 18% GST. If you can reduce that, that will be great. The annuity that you get, anyone beyond, let's say 60, 65, when you're taking a pension, if that can become tax-free, I think it will give a great fillip to retirement as a whole. And I'm not just talking about ULIP or anything else. Making annuity tax-free, I think would be great.
Okay. With that, we come to an end of this very interesting discussion. Thank you so much, Madhu, Srinivas and Vivek, for sharing your views on a very important, but as I said, a topic which often gets overlooked. We'll come back soon with a new episode, with a new topic, with a fresh set of experts to help you navigate the paths of insurance. Till then, stay safe, stay insured. Thank you so much for joining.
CNBC TV 80, the Policy Bazaar Insurance Show.